Hey everyone, me Kevin here. We got to talk about two things regarding the Federal Reserve. Number one, the Federal Reserve is clearly now going to hike rates of 50 basis points. I'm shocked by this U-turn, but it's happening. It doesn't so terribly much surprise me though, because at the beginning of the year, I was really worried about the consumer trending down. That is, the consumer was going to spend less, it was my estimation, that the consumer would turn inward. But instead, the complete opposite is happening. Procter & Gamble is still raising prices because they have more previously lower income cohorts buying more expensive upscale premium brand products, whether it's detergent or Gillette or Braun toothbrushes or whatever, than ever before. And the same thing is happening at other companies. Kimberly-Clark, the banking companies, we are seeing in earnings unmatched demand. But the Federal Reserve released a report that we're going to look at in just a moment that gives us a little bit more color in why the Federal Reserve is going for this 50 basis point hike. However, it's also worth noting that Marie Daly today gave us a little bit of insight that the Federal Reserve is still not ready to go for something like a shock and awe style rate hike. That is, Jerome Powell and others who are actually voting members over at the Federal Reserve, like Loretta Mester and so on, they have made it clear now that even though they're okay with potentially a 50 basis point hike and maybe even one more, that way we can get from, if we do two 50 basis point hikes, we'll be able to get to 2.5% in rates by the end of the year. And this is something the Federal Reserve wants. Previously, in February, we thought they wanted to get to 2%. And now that they want to get to 2.5%, it's obvious that if previously we would have had 725 basis point hikes, well, now we're just going to end up having to have 5 25 basis point hikes and 2 50 basis point hikes. So those are coming, and it's likely that those are going to be the next two meetings that we'll see a 25 liftoff, 50 50, and then 25 25 25 25. Yeah, that's 7. And then we'll be at about 2.5%. So what's this report that just came out? Well, this is what we want to take a look at, and I want to give you just some of the highlights of it. We'll keep it short and sweet, but I do want to make it very clear that right now, news that did break via Loretta Mester and Marie Daly via Bloomberg now is that we are not to expect a shock and awe style 75 BP hike. Who knows? They could end up doing that in the future. Nobody was talking about a 50 basis point hike when we were first talking about, are we even going to lift off, right? Then we started remotely like, maybe we're going to get 50, but maybe it'll be 25. And now it's like, okay, now we're definitely going to get 50. Is it going to be 75, right? So far, they're saying no, but who knows? They could always just U-turn again. Just at this point, you kind of just have to build in and expect further volatility. So what is the report that I want to show you and give you a summary of? Well, it is called the Beige Book. The Beige Report is published 8 times per year, and the Beige Book, and I'll give you a very short, sweet summary on it, is basically the Federal Reserve banks. Remember, the Federal Reserve is an institution. It's a research institution of about 2,000 plus employees. And they do interviews, questionnaires, and they ask and speak to their contacts, whether they're businesses, community organizers, economists, market experts, or whatever sources they can get their hands on, to kind of get a firsthand glimpse at what businesses are feeling. This is kind of like how we read the earnings reports to listen to what the CEOs are saying, because those are kind of like our ways of understanding the CEO's optimism for growth in the future. Like when Jamie Dimon at JP Morgan says, hey, by the way, we think bank balances are going to go up this year. That's great. That's bullish. That's a good thing. That's the opposite of what we thought. Remember, me and the Fed together, we thought consumers would slow spending because of the war. Jerome Powell called the war a, quote, game changer. And because of that game changer, we thought, oh no, this could make consumers stop spending. And if consumers stop spending, then inflation will go away. But that's not what happened. And the Beige Book is going to give us some color on that. But before I open the Beige Book, I do want to give a quick shout out to our sponsor today. Here you go. Thank you to today's sponsor, North One. North One is the perfect tool for small business owners and entrepreneurs because North One is a mobile banking app built specifically for small businesses. Their app gives you access to a lot of features that you can use to manage your money from anywhere. That means you can effectively manage your business's finances with tools like mobile check deposit, cash withdrawals, the ability to send and receive ACH and wire payments, and all of these features mean you'll never have to go into a bank again. No more waiting in line. It also integrates with popular accounting software to save you hours of manual bookkeeping. And now, North One is giving you the opportunity to win $5,000 and up to 10 smaller prizes of $500 for your business. All you have to do is sign up, which only takes 3 minutes. So click the link in the description down below to get that deal and take your business banking to the next level. Signing up with North One means you will be joining over 320,000 businesses across America who have made the switch to North One. Their app and debit card mean that you'll never have to walk into a bank branch ever again. So if you want to win $5,000 for your business or side hustle, well, let's thank the sponsor we got today here, which is North One. Check them out at the link in the description down below. Okay, folks, so here's the Beige Book, and I'm just going to read some of these highlights to you. So take a look at this. Economic activity expanded at a moderate pace since mid-Feb. Okay, so this is interesting first because it's like, okay, well, since mid-Feb is basically when war was, right? So we've expanded since then, but listen to the word choices they used, and I've highlighted these word choices in orange here. See right here in orange? Listen to this. Consumer spending accelerated among retail and non-financial services. District contacts reported continued strong demand for real estate. Demand for workers continued to be strong. Persistent labor demand continued to fuel strong wage growth. Strong demand generally allows firms to pass input costs to customers via fuel surcharges or whatever. Firms in most districts expected inflationary pressures to continue over the coming months. Tourism, spending, and manufacturing activity all picked up in New York. And we'll go through some of the different areas here in just a moment. But what do you notice there? Well, first of all, the reason I believe they talk about since mid-Feb, well, first of all, is that's when we had the last Beige Book, but most importantly, mid-Feb is this report being done between basically from when the war started and now is really a way of us looking into the Federal Reserve's brains and what are they thinking? Well, they're thinking we can't allow inflation to get away. It is getting away. What's driving inflation? It's more demand. Okay, well, we just had a war, which on one hand, war could actually lead to more inflationary costs like we're seeing with commodities, whether that's wheat or gas, which increases input costs for producers. Producer prices go up and eventually consumer prices go up, right? That's obviously inflationary. But war can also create massive disinflationary fears because if everybody just stops buying and they hunker down and they stop traveling because they're fearful, then inflation actually could go down more than you see those prices like food and energy skyrocket. Now, I know that sounds crazy. And in this, honestly, in this instance, it is crazy because it's not what's happening. Consumers are like, oh, crap, there's a war in Ukraine. Let's buy Ukrainian merch. Let's buy Ukrainian flags. I did too, okay. Let's go travel more and live it up more because YOLO, you only live once. Like, okay, war sucks. We want it to end. Our hearts go out for the people in Ukraine and the Russians who are involved who don't even realize all the things that are going on. War is so terrible and so tragic. And we always have to take a moment to realize how fortunate we are not to be experiencing these sorts of atrocities. But the point is, for whatever reason, the U.S. consumer is still freaking booming. And so now you've got the Fed going, wait a minute, we thought war was a game changer because consumers would spend less. They're actually spending more. Oh, crap. Let's U-turn. And this is what I call the Fed's U-turn chart. 1, 2, 3. All right, here's the U-turn. So first, we talked about this a little bit earlier, that we're on this sort of inflation is transitory aspect, right? But then, oh, wait, no, inflation's continuing to go on. Oh, but don't worry, war is a game changer. Oh, wait, no, consumers are still spending. Let's go with 25 BP. Oh, crap, wait, consumers are still spending even more. Let's go with 50 and then maybe level off and do 25s again for the rest of the year and see where we go. All right, so this is what the Fed is seeing. Let's take a little bit more of a look at the Beige Book here. The war, listen to this, like, the fact that this is in the summary of Cleveland, all of this pink right here is in the summary of Cleveland, should tell you that what I've just explained is literally why the Fed is like, oh crap. Now, a lot of people, and I hate this, but I also get it. A lot of people, they leave me comments and go, Kevin, the Fed's a liar. They've lied to us all along. They knew what was happening. I honestly don't think that they're liars. I just think they were wrong. Those are very different things because a lie implies that somebody's trying to deceive, which maybe that's what you think. Fine. I don't believe that's what they're trying to do. I honestly think they thought, oh my gosh, demand's going to plummet because of this war. I placed money on those bets, okay? I was wrong. So was the Fed. Read this. Here you go. Look at this. The war in Ukraine had little meaningful impact on current demand for goods and services, but added other complexities to supply chains. In other words, we got all of the bad with none of the good. Like, war gave us no demand destruction. It just gave us, if anything, more travel demand and more supply chain constraints. And now higher gas prices and so on. Atlanta, retail sales high. Consumer spending on services in St. Louis rose. Oh, which reminds me, we'll go back to St. Louis there in a moment. But I did think this was interesting. Some contacts reported early signs that the strong pace of wage growth had begun to slow. This is good. This is that argument that maybe we're starting to finally peak in terms of inflation, right? Not saying I don't want people to be paid more. I'm all for people making more money, but we do need prices to stop going up at some point, right? Here you go. Look at Kansas City again, because it shows you how important this Ukraine thing was in the decision making of the Fed. The invasion of Ukraine disrupted supply chains and caused input prices to rise, but district businesses reported no effects on demand. In other words, we got all of the bad with none of the good. Retail sales activity in San Francisco continued to expand, especially travel. And then we get into the individual districts, which in terms of individual districts, Boston, I made a note that companies are still planning to have further price increases. I made a little note on the side there. That's exactly what Procter & Gamble said, more price increases coming. New York, consumer spending picked up somewhat in the New York region. I'm only giving you in the actual region, some of the big ones here. This was interesting. Some softening is expected in consumer spending over the next few months amid expectations of smaller tax refunds due to the advance of the child tax credit. That's because ordinarily you get a $2,000 tax credit, but now it was broken up for each child. But now it was broken up into $3,000 or $3,600, but half of it was advanced to people in monthly payments at the end of last year. So now that's from September through December. Now you're getting that second half, but that second half, half of 3,000 is 1,500, which is actually $500 less than you would have gotten under the other tax credit regime, right? So that's kind of what they mean here. Pricing power was consistent with other reports. Over here in Chicago, consumer prices moved up due to robust demand. Consumer spending moved up modestly over the reporting period, led by greater tourism and leisure. Go over to San Francisco, same thing I believe with travel, robust demand for travel and dining. Professional events and conventions slowly returned to being held in person, but are not yet at pre-pandemic levels. Demand for air travel recovered further and in some cases outpaced pre-pandemic levels. So folks, if you're wondering why the Fed seems so wishy-washy, it's because they're making textbook decisions. They're like, okay, we have a COVID pandemic. We injected the economy with a lot of money. We're going to have temporary inflation. 1, base effects, and 2, reopening. Okay, great. Then we get hit with Delta and Omicron. Everything lasts longer. We spend more money. We have more supply chain disruptions. Great, the inflation just lasts way longer. Dang it. They were wrong, okay? It wasn't transitory because other events happened that made it not transitory, right? We printed way more money than we should have. The money printer has a huge part of the blame here, obviously, but it certainly avoided the depths of a recession, but now we're dealing, or a depression, but now we're dealing with the other end of that, right? So, and then of course, the war, they were wrong about that. Again, we got the bad with none of the good. And so I think that's why we saw the Fed U-turn here. This Beige Book really gives us a lot of color in terms of this, understanding where the Fed's head is. Hopefully that helps you. And if it does, hey, consider subscribing. And folks, we'll see you in the next one. Goodbye.